Now we discussed financial statements and financial ratios
Yeah.
in detail, and I hope everybody think there's somebody has come. It's Mr. December. Let's wait for
Oh,
him. He's joining.
okay.
Welcome, December.
Thank you.
Good. Okay,
Thank
so
you. Thank you.
you can mute Akim.
Okay.
Okay, so we start. I was saying that we discussed financial statements, which are very important records in businesses, in corporations. There are reports that represent what has happened, and you can use them for many purposes, depending on who is looking at them and for what purpose. So financial ratios are calculated by each stakeholder, any interested party, which we listed as investors, bankers, suppliers, customers, MRA, and many others. So we have lost Akim. We will continue. So of those financial analyses that represent what financial ratios are, there's another financial analysis which is very important that we did not discuss last time we met. And this financial analysis is different from the others because it is not an accounting analysis. It represents an economic analysis. Now, you remember when we were discussing the concept of costs, we had accounting costs and economic costs. If you remember, we said economic costs are equal to accounting costs plus implicit costs, because accountants do not capture what is not on the record, but economists capture beyond what is in the record. So economists look at opportunity costs in addition to actual costs. So therefore, you can imagine that because of that, economists will look at more than just accounting costs when looking at this performance of a company. So performance of a company in the economic sense includes economic costs, which are usually what we call opportunity costs. Now, one of those analyses that is done is called economic value added. Economic value added. Let me share some notes about that, and we can go through together. Just waiting for the others to join. Okay, so good. Now we have both Akim and Rose in. That's good. As I was saying, we have an analysis, a measure of financial performance, which is done by economists, which is more than what accountants do.
Sir, my apology for interruption.
Yes?
Narudi naduka.
Yeah.
There was the wonders in Zuidi. On a sad note, then the 19 zango, I assigned Ula drama Saturday. Nde zapeza kuti dzulo sana ondiyere ku ofesi leronso chimodzimodzi titapita nyumba kwake sinampezeso nde ndapanga breakdown nyumba yake kupita ndi apolisi lake inafu ndalama zazipeza komano nkhawati kuti iye sakuoneka ndalama nangosunga nyumba so ndikulandira foni chifukwa chake ndi interrupted kwambiri nde mafuna kuti muyambireso 1.
Okay.
Yeah.
Long explanation for a very simple answer to a very simple request. Are you able to see my screen?
Mafuna verses, yeah, I am able to see it.
Okay, now what I was saying was we looked at financial statements and what financial ratios you can develop from these financial statements. Now, these financial statements or financial reports are produced by accountants. Okay, let me close the door. Just hold on a second. Yeah. These financial statements are prepared by accountants, and they represent a story about how a company has performed. So they represent the actual transactions that has happened in a company. But remember, when we were doing the concept of cost to a company, we have differences between an accountant and an economist. The profit for an accountant is basically total revenues minus total costs. But for the economists, the profit is equal to the accountant's profit, which are representing actual costs, but the economists include implicit costs, which are actually not costs that you record in your books of accounts. So these are costs such as opportunity costs. So the accountant's profit usually will be higher than the economist's cost. So the economist looks at the actual and what could have been. So for example, if a business is using its own buildings, as we said, as we explained last time, the accountant will not indicate rent. And yet the economist will say, this building, you could have rented it out. How much could you have rented it out? So much. So that is a cost that you should include. Even though there was no check written, there was no payment, actual payment for rent. So the understanding of costs for the accountant and the economist are different, because the economist looks at the accountant's cost plus opportunity cost. So now, when you are measuring the financial performance of a company, you can imagine that these two people will have a different view. So the economic value added is one of those measures of financial performance, especially by economists. It is based on residual value calculated by deducting the cost of capital from operating profit and adjusted for taxes on cash basis. So this economic value added is also sometimes referred to as economic profit, because it is trying to capture the true economic profit of a company. So for example, if you are running your own business and you are not putting your salary there, because you could have been employed somewhere else and get a salary. Now you are running your own business, and yet it doesn't, on the company cost, your salary is not reflected. So it's not a true value of the profit that you are capturing if you ignore the cost of your labor. So economic value added, in short, EVA, is one of those performance indicators that can measure or can be used to measure performance of a company, financial performance of a company. So it is used to measure the value of a company, how much it generates from its invested funds, how much value this company is generating from these invested funds. So it relies very heavily on invested funds, invested capital. Remember when we were calculating return on invested capital. So it relies very much on invested capital. Now, it also has weaknesses, because it only looks at what the company has invested. It doesn't capture, for example, companies that have not invested a lot of capital, but they have skills and technology that they are using. That will not be captured. So it's very asset-based. It's very much based on what you can see as capital that has been invested. It doesn't capture the technology part of it. Technological businesses, they use knowledge, the knowledge that you have, the skills that you have to generate money. So it may not show up as invested capital as such. So that's one big weakness for economic value added as a measure of performance. So how do you calculate EVA? Now, because EVA is an incremental difference in the rate of return of a company's cost of capital, it is therefore measuring what the company is generating from the invested capital itself. Now, the formula is EVA is equal to NOPAT. Remember, NOPAT is equal to NOPAT minus, in brackets, invested capital times the weighted average of capital, cost of capital, weighted average of cost of capital. Remember, one of the ways of measuring cost of capital is WACC, weighted average cost of capital. So NOPAT is net operating profit after taxes. And then invested capital is basically debt plus capital leases leases and shareholders' equity. Sometimes you lease something, you borrow to use it, so that's why it's called lease, capital leases plus shareholders' equity. As you know, invested capital for any business in this corporate financing course, we learned that the source of capital is debt and equity. That's why invested capital is looking like that. So EVA is equal to NOPAT minus invested capital times weighted average of cost of capital. So it's basically looking at the opportunity cost, which is the cost of capital in this case, cost of invested capital. Are we together?
Yes, we are
Good.
together.
Good. Yeah, so what are we learning from the equation? From this equation of EVA. The equation for EVA shows that there are three key components to a company's EVA. There is net operating profit after tax, the amount of invested capital, and the WACC. Now, NOPAT in the financial statements, usually you calculate it yourself. You will not easily find it listed as NOPAT in the financial statements, that is balance sheet or income statement or statement of cash flow. And invested capital is the amount of money used to fund a company or a project. WACC is the average rate of return on a company that a company expects to pay its investors. So the cost of capital, basically. WACC sometimes is provided, but in most cases, you calculate it. Now, the invested capital in EVA is usually calculated as total assets minus total liabilities. So two figures which you can easily find in a balance sheet. It's not difficult to calculate. You can easily find them in a balance sheet. So, because we are saying invested capital is equal to total assets minus current liabilities, and therefore you can substitute this in your formula above. It makes life easier. Yeah. So I think it's important to note, to acknowledge how this concept was developed. It was by a company called Stern Value Management, developed sometime in the 80s, 1983 especially. So that's when this concept came into being. It is at the moment quite popular. A lot of people try to use it. Basically, it's far much related to profitability ratios that we talked about, which, as you know, is a primary concern for stakeholders such as investors and probably long-term customers, maybe suppliers, maybe not, unless you can find suppliers who don't mind to be paid for what they have supplied in a 6 months time or in a year's time, which is probably very rare. So it's more its relevance is more of those who are doing long-term investments, long-term financing. Now, we can look at advantages and disadvantages of EVA, as we said. The disadvantage of EVA is it relies heavily on amount of capital invested. So it is very relevant for companies which have got a lot of assets, and those companies which are stable and mature. Now, companies which have got intangible assets, such as technology businesses, as I said, technology will use, maybe you are using your brain and skills. So you don't have tangible assets. You have intangible assets. Your asset is in knowledge. So technology businesses, these are not very good candidates for doing an EVA evaluation on them, doing an analysis of EVA on such companies. So it is only relevant to asset-rich companies. However, EVA is good in the sense that it assesses the performance of a company and its management through the idea that business is only profitable when it creates wealth and returns for shareholders. You know, if a business is not creating wealth for its shareholders, it's not good enough. So EVA is very important for that purpose. So it's a useful performance indicator. It shows how a company created its own, it created its wealth, and usually this is in the balance sheets that you find most of the items there in the formula. Okay. I will share these notes I'm sure on Saturday we'll meet in person when we'll be doing areas of study. Just remind me. It might be one of those important assessments that you may actually be examined on. So please read more about this EVA thing and see whether my presentation is good enough, or you may actually find some extra information that can help understanding the concept of EVA, economic value addition, or economic value added to the company. Now, another concept that comes out of assessing performance of companies through financial statements and the various ratios that you can develop, including the EVA analysis or evaluation. What you might learn from these is that, one, you can predict the future of how the company is performing and how it is likely to perform. But also, you can be able to detect which companies are in problems, which companies are struggling. So for example, the example I gave you last time we met, I talked about a ratio that you would calculate. For example, I said, I may not give the exact example I gave, but let me, because it's very important that you understand this concept very well. The issue about, let's say, company A has got a turnover or sales volume of 100 million, and it's making a profit, and it's declaring a profit of 50. Another company has a turnover of 500 million and is declaring a profit of 100. That's what the income statement will show. Now, you are looking for a company that you want to invest in. Will you say, okay, this company, which has total sales of 500, and it has made a profit of 100 million from its 500 million sales, is this profit performing better than this other company, which only sold 500 million, but they produced a profit of 50? From the figures as they presented, you might think that company B, because it has declared a profit of 100 million, is better off than company A, which has declared a profit of 50 million on the face value. So would you say, okay, let me invest in company B because it has 100 million profit? Or would you say, I invest in company A, which has 50 million profit? You need to do more analysis for you to make a better decision. So you would probably want to calculate a ratio. So in this case, you will say income, because income and sales are not the same things. Sales of a company, for example, if you go in the income statement, you have sales revenue. And then the second item in there says cost of sales. Then below it is gross profit. And then you have other expenses, depreciation, blah, 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 taxes. And then you have, at the end, you have net income. So what we are saying is volume of sales may not indicate for you as an investor the profit that you will get. The profit is only the income, which is the profit. Now, in this case, you need to calculate which company is faring better. So you calculate a ratio. So you say, for example, income over sales, profit divided by sales volume. So in company A, profit is 50 divided by sales, which is 100, you get 0.5 financial ratio. Company B, income, which is profit, is 100, divided by total sales or volumes or turnover, which is 500, you get 0.2. So you can see the financial ratios. Company A has a financial ratio of 0.5. Company B has a financial ratio of 0.2. So which is bigger? Obviously, 0.5 is a bigger financial ratio than 0.2. So these are some of the things you may want to see. So, and what story does this tell you? The story is that Company B is struggling to make a profit. If economic conditions change, let's say there have been some problems with the economy, Company B is struggling to make profit, and therefore it is likely to be hit or not to make any profit at all if there are problems in the system. Company A easily makes profit, even though it looks a small company. But you can easily guess that this company, even if there are some changes, some adverse conditions in the economy, they will easily make a profit because for them, it's so easy to make a profit. So that's the story that these financial ratios are telling you. So as an analysis, as an interpretation, you should be able to explain these things along those lines. What story are they giving you? Now we have a situation here of Company B, which is struggling. Now, usually, when we talk about struggles in a business, we look at we have a term for these companies that are struggling to make profits, and usually we refer to them as companies which are in financial distress. They are distressed. So financial distress happens, and sometimes it can lead to bankruptcy. So we have less than a minute. I will be cut. I will reconnect in probably 5-6 minutes after we are cut, and then we will finish off maybe about 20 minutes lesson talking about financial distress in a company. And that will be the end of coverage of coursework for this semester. So next we are discussing financial distress. Give me 5-6 minutes after we are disconnected. Anytime we are being disconnected. So don't run away. We spend too much time waiting for other people and spend only 30 minutes actual learning. So please, when I'm in there, come fast.